Welcome to this explainer, everyone. Today, we've got a fantastic and honestly incredibly practical topic to unpack. We're going to be demystifying mutual funds, and I am absolutely thrilled to be presenting this in partnership with PCS Capital. They are an AMFI-registered mutual fund distributor holding ARN 134593, and they are basically going to be your trusted guide to building wealth right here in the Indian market. We've pulled some really valuable information straight from the Association of Mutual Funds in India, AMFI, and we're going to break it all down so you know exactly how these financial tools can go to work for your future. Okay, let's dive into this. We've got a simple 5-step roadmap today. First, big goals, limited time. Second, what are mutual funds? Third, how do they work? Fourth, why invest in them? And finally, important investment disclaimers.
Starting right off with Section 1, Big Goals, Limited Time.
So, I want to ask you a question. How on earth do you grow wealth when you just don't have the time to research stocks? It's a deeply relatable problem, right? We all have these huge aspirations. We want a comfortable retirement, we want to provide for our families, maybe buy that dream home, but the mere thought of sitting down for hours on end, analyzing balance sheets, tracking every market trend, and trying to somehow become a stock market expert is completely overwhelming. If you've ever felt anxious because you just don't have the time to be a market genius, let me tell you, you are absolutely not alone.
In fact, if we look at the profile of the ideal mutual fund investor, it describes a perfectly normal situation for everyday retail investors. Look at this. Number 1, you lack the knowledge or skill for direct stock market investing. Number 2, you really want wealth growth, but you just lack the time to do the research. And number 3, and this one is super common, you might only want to invest small amounts right now. If any of that sounds like you, well, you are exactly who mutual funds were designed for. It's a tailor-made solution.
Which brings us nicely to Section 2. What are mutual funds? To capture the absolute essence of it, a mutual fund is a collective pool of money contributed by several investors and managed by a professional fund manager. Now, I really want you to lean into that collective pool analogy for a second. Imagine you want to buy a massive, highly diversified piece of real estate, but you only have 1,000 rupees in your pocket. You can't do it alone, obviously. But if you and 100,000 other people all pool your 1,000 rupees together, suddenly you have immense buying power. Combining your money is what grants you, the everyday investor, direct access to elite professional management.
So what actually happens to that giant pool of money? Well, your professional fund manager takes it and spreads it out across very specific investment avenues. Depending on the goal of the specific scheme, they might invest in equities, which are shares of companies designed for growth, or maybe corporate bonds and government securities, which offer a bit more stability, or even money market instruments for short-term liquidity. The main takeaway here is that your pooled money isn't just sitting in a vault gathering dust, it's being actively put to work across these different asset classes by a seasoned expert.
And if you're wondering about safety, you'll be glad to know the Indian context provides a highly robust framework. Mutual funds here are highly regulated entities. They're actually established as trusts under the Indian Trust Act of 1882. On top of that, their operations, fees, the whole shebang, are strictly regulated by SEBI, the Securities and Exchange Board of India, under their 1996 regulations. So there are very strict limits and guidelines governing exactly how these funds operate. It offers a massive layer of reassurance for your hard-earned money.
All right, moving on to Section 3, how do they work? Let's pull back the curtain on the actual mechanics. It really boils down to a super simple 1, 2, 3 journey. Think about a single rupee as it enters the system. Step 1, you and a bunch of other investors pool your money together. Step 2, the professional manager takes that collective pool and invests it into assets, just like the stocks and bonds we were just talking about. Step 3, any income or gains generated from those investments get distributed proportionately back to you. And this is all tracked through something called units. When you hand over your money, you get issued units right back in exchange.
Now, what's really interesting about this is how it demystifies a huge piece of financial jargon you're going to hear constantly: NAV, or net asset value. Simply put, this is just the price tag of a single unit of your mutual fund. It's the per unit value. So when the collective pool makes money, the NAV goes up. When it loses money, the NAV goes down. All of that proportionate income or those gains distributed to you are calculated based on this NAV. And a really important note here, this value is calculated after the fund has already deducted its applicable expenses and tiny management fees.
So let's talk about the returns you get from holding those units. They basically come in a few different flavors. First, the fund itself might earn dividends from the stocks it holds, or interest from its bonds, which can be passed on to you as income. Second, you've got capital gains. That's when the NAV increases over time and you decide to sell your units for more than what you initially paid. But let's keep it real and neutral here. There is always the potential for capital losses too. If the market underperforms and that NAV drops, selling your units for less than you invested means taking a loss. Ultimately, the very act of selling your units is what locks in your realized capital gain or loss.
And that brings us to a very, very important number, 18 to 24. What does this mean? Well, this is the number of months of patience you generally need at an absolute minimum for actively managed equity schemes to actually generate returns in their portfolio. I know. It is incredibly tempting to check your fund's performance every single time the market jumps or dips, but the source material explicitly advises against that kind of panic checking. Wealth creation in the Indian capital markets demands a long-term mindset. You've got to give the fund manager reasonable time, again, around 18 to 24 months, to just let their strategy play out.
Let's jump into Section 4. Why invest in them?
The major advantages become crystal clear the second you compare the two main approaches. Trying to capture capital market uptrends by buying individual securities on your own, it's incredibly difficult for the average retail investor. It's high cost because getting proper diversification requires a lot of capital up front, plus it demands massive amounts of time and expertise. Mutual funds completely flip that script. They give you a low cost of entry, you get immediate diversification, and honestly, the best part is you get to hand off all those complex, stressful investment decisions to a professional manager.
And this brilliantly illustrates how versatile mutual funds actually are in the real world. Because, look, everyone's investment goals are different, so the solutions have to be adaptable. If your big goal is covering post-retirement expenses, mutual funds give you diverse choices across growth-focused equities and stable bonds to balance your risk. If you're saving for your children's education or marriage decades from now, they let you stay invested to benefit from those long-term capital market uptrends. Or if you're just looking to buy a house, they're incredibly accessible, meaning you can start right now with very small, regular investment amounts.
Which brings us to our final stop, Section 5, Important Investment Disclaimers.
I want to pause here and emphasize that this next part is a demonstration of our commitment and PCS Capital's commitment to absolute transparency. You've probably heard this phrase spoken at lightning speed at the end of television commercials, but I'm going to say it clearly and deliberately because building trust is absolutely crucial to us. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. All that really means is that while mutual funds are amazing tools for wealth creation, the value of your investments will go up and down based on market conditions. It's so important to know what you're investing in. And remember, PCS Capital, holding ARN 134593, is right there to help you navigate all those documents and choices.
So I'm going to leave you with one final provocative thought to chew on. Are you ready to take the first step towards your long-term financial goals? You know the mechanics now. You've seen the sheer power of pooling money, the massive benefit of professional management, and why patience is your best friend. The entire framework is sitting right in front of you. The opportunity to dive into the Indian market is right there. So the only real question left is, when are you going to begin your own wealth creation journey? Thank you so much for joining me in this explainer today, and happy investing.